Welcome to the daily stock review of Goosehead Insurance. Goal of this channel is to uncover the world's best stocks to have 100x potential by reviewing 1,000 stocks in 12 months. That's roughly 3 a day. If that sounds good, subscribe to come along. Who am I? I'm an individual investor on the journey, 2,500 hours in over the last 7 years, and I'm sharing lessons along the way. Here's my investing process. Got 5 steps. Today I'll give you a rundown on how I came across this stock and the 5-minute check I'm going to do to see if it's worth looking into further. I learned off these guys. They did pretty well for themselves over just a little while, and they destroyed the market. And by following in their footsteps, we should be able to follow the breadcrumbs that they've left behind and achieve some of that success. These are the free resources that I wish I had when I first started out. You can grab those with the link in the description. Otherwise, let's get started. Alright, so Goosehead. How did I come across it? There's some checks you can do, especially on US companies and most other companies that are on stock exchanges. They have public filings for when insiders within the business buy a portion of it. And as the old adage say, there's many reasons for why management and other people like that sell their shares. Might not mean it's a bad reason. They might just need some money, or they've got to go and pay the mortgage off and things like that. But there's only one reason to buy, and that's because they expect it to increase in value, and they're pretty confident in that assumption. So Goosehead Insurance has had a significant number of insider buys in most recent times. So with its current depressed, share price, back down here, a lot of people within the business still believe that it's worth more than that. So what I'm looking for in this stock is the annual report, which I've already found in advance. It's a US based company, so it's in the 10K format. And what I'm looking for is their financial statements to perform this 5-minute check. So what I want to see is mastery. Has the business mastered its customer? I'd expect the revenue to be growing. If I wanted to see if the business has a moat around the business, so I'd expect it to see that in the amount of profit that the business is taking. And sometimes that's easy to see. Sometimes that's a matter of having a look compared to its competitors, because profit margins can differ between businesses and business models. And the other one is management. So I want to see how management's investing its money and spending it. Is it spending it wisely, or is it spending it frivolously and throwing cash out the door and not to shareholders? So let's get cracked into it. So statement of operations is also known as the income statement. I want to look for revenues. So he's got commission and agency fees, franchise revenues, interest income, and total revenues. So let's see what's happening. Commissions and agency fees, there's gone from, what are we talking, in thousands? So 116 million, 139 million, up to 155 million. So there's some strong growth there. Franchise revenues, 143 million, up to 174, up to 209. And then interest income is decreasing, but it's a very small portion of the business that they've included there. So overall, revenue's gone from 261 up to 365. So to me, this is probably roughly going to be about a double every 5 years in terms of the revenue growth. Now let's have a look at, that's a pretty good start. Now we want to have a look at other things that are going on. So income from operations. So there's expenses that come out here. Just looking to see general trends and what we're looking at. So we've got growth from 32 up to 74, so that's a double. So that means our revenues are growing faster than our costs, which is good. What else can we see? We've got our net income. We can see that we've gone from 23 up to 49 and a little bit down to 44. Now, why is that? Where are the big changes in here? Well, we can see that we've got this interest expense, and it's quite significant compared to the others. So if we're looking into this business further, we'd want to have like a closer look at what that number's all about. What's the general trend here? What are we expecting that to be in the future? Is it going to increase? Is it just a one-off for this year? What influenced it, etc.? Because it might be that net income is not normalized and doesn't reflect the growth this business is actually having, which potentially, if it's 23 up to 49, we've got over 15 there, so this could have been closer to 60, which would be 3 times the net income that the business has had. So you can see that at this stage, the general trend is revenues are growing quite quickly. The profit margin of the business is increasing faster because it doesn't have that many costs per unit, so to speak. Now let's have a look at the balance sheet. We just want to check out how the business is kind of structured and if there's any big issues. So total assets minus our total liabilities. We can see our liabilities is bigger than total assets. So let's dig into what's going on. So we've got a significant point here, which is this note payable net of current portion. So 289 million. So total current liabilities, lease liability, and things like that. So for me, we'd want to dig into what this number is, because that is a significant increase to what we've had previously. Let's just have a look through a couple of these other numbers. Is there anything else going on? Any big trends? We can obviously see that our assets over time is increased, which is a good sign. Nothing too crazy except for this one. So, like I said, another point of, if we're doing a deep dive on the business, we want to go and have a closer look at this number here. So note payable, net of the current portion. We want to see what the general trend here is, if that's going to continue to increase, because we want to have a business that's got more assets than liabilities. And in the portion that the business can actually pay its debts. We don't want it to get into a situation where it's at the potential that it's going to go bankrupt. All right, so we can see there, because that number for this year, the liabilities is larger than the assets, that the total equity is actually a negative number. And so all that means for us is pretty much that the price to book and a couple of other different things like that will not be able to be shown up or be shown negative, and yeah, we'll go from there. All right. So it appears that the business has got mastery of its customer. It's growing really rapidly. The business has got a moat around the business. It's got really strong profit margins. Now we want to see how it goes with management. So let's have a look at the cash flow statement. Cash flows from operations, 23 to 49 to 44. Just like what we had before, the net income from the income statement comes out at the top of the cash flow statement. We've got depreciation and amortization, blah, 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 blah. Cool, we've got some commission agency fees receivable. They kind of jump up and down a little bit, so it's a bit bumpier. We've got net cash provided by operating activities. Ew. So we've got 50 million, 71 million, and 91 million. Now, where does the business have to actually invest? So usually it would be, we'd remove the property, plant, and equipment figure from this net cash provided by operations. I just want to have a look down and see if there's anything else where the business needs to continue to invest in to make its money. So proceeds from notes, capitalized software development costs, cash consideration paid for asset acquisitions. So you can see that for me, software development costs and the property and plant and equipment, for me, when I'm calculating free cash flow is pretty much your net cash provided by operating activities minus your capital expenditure. And a better portion of that for me is, minusing what I believe is the moat maintenance. So we grab this number, net cash provided by operating activities, and then we subtract what's the amount that this business needs to reinvest in itself just to maintain its current position. So not to grow it, just to maintain it. So we can see here that this number's a bit bumpy. What I would do is go, cool, I'm just going to pick a number of about 5 million because it's gone from 4.5 less this year in investment and then up to 5.6 million. And then we can see that these capitalized software development costs are increasing as well. So we'd want to have a look at, is this growing in proportion to the amount that the cash flow is increasing? And it appears that it is. It's going from, 5 to 7 or 50 to 7.7, 71 to 11, and 91 to 13. So it's actually growing at a slightly less. Pretty much about the same. 7.7 to 50, we just double that to get to 100. Double this, we get to, a little bit over 15. If we increase this a little bit to 100, increase that a little bit, we get to about the same amount, so 15. So there's about a 15% of the business's cash flow that it's chucking into these capitalized software expenses, and pretty close to about 6-7% that it's investing in this property, plant, and equipment. So we can see there, if we get this number, 91, subtract 13 and 6, we end up with about 70 million in that free cash flow. Now, if it was just maintaining the moat, we'd have to have a look and do a deeper dive into this business. So we're talking 13 and 5.6. It'll probably come out to be less. Now, some businesses do provide that figure for what their what part of their capital expenditure is for growth of the business and what is for just maintenance of it. And usually for a business like this with that much growth and this increase in it, we'd probably expect it to be fairly significant. So more of a 50% going to the growth, and so usually they'll have something written about it. It may not say the exact ratio or the exact amounts across the years, but we definitely need to do digging into that to make some good or better assumptions about what this cash flow figure is going to be in the future. All right. So where is this business spending that other $70 million of cash? Let's have a look. So net in investing activities, Kate's got customer premiums, debt issuance, repayment of notes, proceeds from notes payable. So in this most recent year, it's asked for 306 million in debt or notes payable, so commercial or what do we call them, corporate bonds. And then it's used some of that proceeds just to pay off that. That's where we end up with about that 200 million in notes payable sitting on their assets that they've still got to pay in the long-term liabilities. Now the business will be holding on to that And at the time that this report was done, that's the snapshot in time. So the business has got that extra 200. What are they going to do with it? That's why we need to read the annual report to see what the plans are for that cash. We also know that the business is making about 70 million. So where's the rest of it going? We've got proceeds from the issuances of Class A common stock. So it's still doing some small amounts of capital raising by selling some of its own stock in the public market. And then we've also got repurchases of Class A common stock. So it's actually, with its extra cash, it's buying back its own stock. What else is it doing? It's got member distributions, payment pursuant to tax, and dividends to shareholders. What? So this is where we need to go and dig into it. So we started off with about 70 million in cash that the business has got to spend by the time we get to this point down here. Now they've got 306 in debt. They've paid off 100 of it from that was older debt. Now we're left with 200 and about 270 million all up. Now the business has spent 80 on that, so we're at about 190 now. Business has then gone and spent member distributions, so we're at what, 110. And then the business has spent more on dividends to stockholders. So digging into these numbers, like, it seems a bit strange to me for if the business has gone out and asked for additional, raised some debt that it needs to pay in the future, that it's just, instead of reinvesting it in the business, it's given 145 million of that to its shareholders. That's a bit, of a strange one. So that's why we need to read into it and go from there. And that means that because we had about 110, some other adjustments here happen, we end up with a smaller cash position by the end of the year. So this is an interesting one. Honestly, obviously good signs are that the business is repurchasing its own stock. That's usually a pretty good sign. It depends on what price it's purchasing it back at, though. If it was purchasing it while the business was significantly overvalued, that would be a stupid decision. And from here, if my assumption around that the business has raised debt of 306 million and it needs to pay that in the future, but instead of reinvesting it in the business, it's just paid it straight out to dividends to stockholders, that is pretty stupid as well. So for me, would I be looking into this stock a bit further? Say yes. On the basis, though, of this business has some very significant growth. In the market, we're talking about a price to earnings ratio of pretty much 50. But we can see that, over time and going max, this stock's been up and down over time. So it looks like it's been either fairly cyclical or this growth has been going on and people have then gone, it's not worth that much, and then gone back down. So having a look at some previous reports, seeing the trend over a longer period than just 3 years is a good way to shore up that certainty around where we think it'll be in the future. All right. Now, if you like this, you got any questions, drop some comments. I'll read them and I'll be able to review them in future videos. And if you want to see more of these, click subscribe, and otherwise check out this next video because YouTube thinks you'll like it. Cheers.